Suppose you were an investor, and several decades ago, a Stanford MBA named Joe Colomb came to you and requested an investment in his new grocery retailer. He described the retailer he envisioned operating. They were going to be very small stores, fairly cramped aisles, small parking lots. He envisioned opening these in low-rent, beat-up strip malls where he could have low rent for his space. He wanted to offer a limited selection of goods, and not nearly as many as the typical supermarket. He didn't want to sell any branded goods. He wanted to only sell private label. He wasn't going to accept coupons and do any television advertising. He didn't envision a loyalty card or any self-checkout lines. He didn't really envision sales. He didn't even want to have inserts in the Sunday newspaper with advertisements about what was on sale that week at his firm. Would you have invested in Joe Colomb's new grocery retailer? I suspect many of you would not have, and you would have made a big mistake, like many others did at the time, because Joe Colomb opened a chain named Trader Joe's that went on to become one of the most successful grocery retailers, really retailers of any kind, over the last few decades. Now, the Albrecht family of Germany, they believed in Joe Colomb. They actually bought his firm. The Albrecht family owned a chain of grocers in Germany and other places in Europe called Aldi. And they acquired Trader Joe's, leaving Joe Colomb to run the stores as his CEO. And great success followed. In fact, this company has passionate fans. It's incredible the lengths to which people will go to demonstrate their love for Trader Joe's. Facebook pages have been created trying to get people at the company to open a store somewhere close to the owner of that Facebook page. There have been people that have gone on Twitter and created accounts describing the, quote, yummy, healthy Trader Joe's items on their shopping list. That's the @TraderJoe'sList Twitter handle. She has more than 55,000 followers. A customer has created a "If I Made a Commercial for Trader Joe's" homemade video on their smartphone, and they've accumulated 925,000 people who viewed the video. It's incredible to see the amount of attention that the firm has gotten from these passionate fans. There have even people who've written cookbooks featuring meals prepared strictly with the firm's products. People wait in line for hours before a new store grand opening. Joe Colomb has once said, "I own the cult." He says, "My children say that the Albrechts own the business, but I own the cult." It truly is a cult-like, passionate following. Trader Joe's doesn't have customers, they have fans. And any company would love to have fans, not just customers. It's interesting to watch how the firm has succeeded and how much attention it's gotten for its success. In 2013, they've been ranked highly in a number of measures by a number of different periodicals. They are considered one of the most successful grocers in the United States. For example, their sales per square foot is said to exceed that of most major grocery chains, even significantly higher than top performers such as Whole Foods Market. Customers ranked it their favorite supermarket in the US in a 2013 survey. Consumer Reports ranked it as the second best supermarket in the nation. Fast Company gave it high marks for innovation, and Forbes lists the company as one of the top 25 firms to work for in 2013. Trader Joe's claimed that 80% of its customers had attended college. The company described its target market as intelligent, educated, and inquisitive individuals. It had a very clear view of who its customer was and how it wanted to serve that customer. They focused on people who were health conscious, enjoyed travel, and liked trying new things. Tony Hales, a store captain, as they call their managers, described the clientele. He said, "Our favorite customers are out-of-work college professors, well-read, well-traveled, appreciates a good value." Industry consultant Kevin Kelly described the target customer as, quote, "a Volvo-driving professor who could be CEO of a Fortune 100 company if he could get over his capitalist angst." I seem to see a pattern here. Professors like me seem to love Trader Joe's. But I don't love Trader Joe's just because of the in-store experience. I love it because it's a high performer. Not only does it have passionate fans, but it's returned tremendous profits for its investors over the years. It succeeded by creating a place where people want to work, where customers want to shop, and where investors want to put their money. How have they done it? How has this upstart from California, owned by a German corporate parent, outcompeted many formidable rivals in the supermarket business? They've known their customer, They've known them very well. That's certainly one first step. A little more about the Trader Joe's customer. I think it's interesting. There was a Los Angeles Times article, and it wrote, "These are people who wear sunscreen even over their tattoos, who travel on frequent flyer miles, and with the Lonely Planet Guide rather than Frommers." You know, it's people who really love to shop there, but who are quirky, who are different. They want something other than the usual supermarket, and they found it in Trader Joe's. And the cult-like following is demonstrated when they open a new store. People waiting in line overnight in Spokane, Washington. People were there from 3 o'clock in the morning. People taking days off from work to pitch their tent-like chairs and their setup overnight so they can stay there and wait for the doors to open. People flocking and forming long lines. In certain cities, they've even had to bring police in to manage the traffic around a new store because so many people flood there on the first day. In Manhattan, when they opened a new store, the lines wound around the block. And again, police had to help manage the flow. And they could only let certain amounts of people in the store at once because so many wanted to get in at the same time when the doors opened. Well, what's the secret? How do you create a company that has such a passionate following and that's done so well for its employees, its customers, and its investors? Well, let's list for a moment what Trader Joe's does not do. The things that most other grocery stores typically do, that Trader Joe's does not. They don't offer many branded products. It's almost all private label. Actually, with very funny names, right? It's Trader Joe's private label. As they produce foods from other countries, they simply translate Joe into that language and apply that. So Trader Jose for Mexican food, Trader Jacques for French food, etc. They don't have spacious parking lots. They don't have spacious stores with wide aisles. They don't offer self-checkout or TV ads. They don't accept coupons or have a loyalty card. They don't really run sales and no TV advertisements. And interestingly, they don't have a large selection. A typical Trader Joe's location might have 3,000 or 4,000 items in it. A typical supermarket, like one run by Kroger, might have 30,000 or 40,000 items in it. And finally, there is not a stable product line at Trader Joe's. Products come and go. This week you go there and you love their mango salsa. Next week you go and it may not be there. Not because they're out of stock, but because they've moved on and they're offering a different item in that space. Well, what's the lesson from this company that's choosing not to do all these things that a typical grocery store would do? Well, Michael Porter once wrote, "The essence of strategy is choosing what not to do." You can't be all things to all people. And to not be all things to all people, it means really identifying not just what you're going to do, but understanding what you're not going to do. Being very clear about the things that rivals are offering that you're choosing not to offer. Why is this so important? What is the value of this concept of making trade-offs? Well, trade-offs offer several key advantages. First, they make you distinct. The more that you've chosen a very different set of activities and a different set of offerings than your competition, the more you're unlike them, the more you're different. And that's important, as we've said in prior lectures. But even more than that, making trade-offs, choosing carefully what not to do, makes it very hard for existing players to imitate you. And that's important because not only do you have to be able to achieve competitive advantage to generate high returns, you have to sustain that advantage. You can't be easily imitated if you want to have long-term success. And making trade-offs, choosing what not to do, can actually make it very difficult for others to emulate you. And finally, making trade-offs can help you mitigate the negative forces in your industry. They can help you deal with high buyer power or high supplier power or strong threats from things like substitutes. So choosing what not to do makes you distinct, hard to be imitated, and can help you mitigate negative forces in your industry. All important if you're going to achieve long-term success. Think about the strategies of some leading firms in past decades. Southwest Airlines, eHarmony, Edward Jones, and Planet Fitness. Southwest succeeding in the tough airline business. eHarmony succeeding in the online dating market, creating a marketplace where people can match and find people they're interested in having a long-term relationship with. Edward Jones, a brokerage house, competing with the likes of Merrill Lynch and others, very successful over the last few decades. In Planet Fitness, in that very difficult fitness center business, they've done very well. How have these firms done it? Well, take Southwest. No assigned seats, smaller regional airports, not having multiple jets in their fleet. They only have one kind of plane. Not offering inter-service. You can't transfer your bags to other airlines. Not operating a hub and spoke system. Instead, offering point-to-point service between certain airports. They've chosen to not do what many major airlines have done. eHarmony, choosing not to be in the business of casual dating matches. They're not trying to find that one-night stand for you. They're not trying to find that person you might date for a month and then move on to find someone else. They're trying to get people married, to establish and help people establish long-term relationships. And they've done some things to actually push away the casual dater from their site. How about Edward Jones? They don't offer online brokerage services. They don't want you trading online. They don't want to sell initial public offerings, commodities, penny stocks. They don't offer a huge array of investment banking services, as many other brokerage houses also do. They've chosen to be the trusted advisor to conservative clientele who are interested in long-term investing. And they made a set of trade-offs to distinguish themselves from the competition. And finally, Planet Fitness. They're sort of the gym for people who aren't fitness freaks. The gym for people who get put off by fitness centers that cater to people who are incredibly into their regimen. They want people who are just trying to lose a few pounds or get in a little better shape, and they're just interested in a place that's safe, that won't make them feel awkward, and the like. And you see in their ads how they've exemplified in their advertisements this strategy of trade-offs, right? The great ad where this really buff man comes in with bulging muscles, and they ask him what he wants from his fitness center, and he says, I pick things up and I put them down. And he repeats that 3 or 4 times, and eventually they escort him out of the building. They don't want him as a customer. How many companies do you know create advertisements that say, these are people we don't want as customers? That is the ultimate strategy of making trade-offs. But by doing that, they make themselves even more attractive to the person who's casually into a fitness regime, who's trying to lose a few pounds, but who doesn't want to be intimidated by the bodybuilder. So by pushing the bodybuilder away, they bring in the casual fitness person. They've done it very well, making trade-offs. Really key, but many firms don't do it. So could people imitate Trader Joe's? And why do trade-offs help make it difficult for others to imitate Trader Joe's? Well, consider the case of Kroger's, a large supermarket chain in the United States. They've made historical commitments that are rigid. They can't just change their entire store format to be able to mimic Trader Joe's. They've got large stores with wide aisles. They have many branded goods in their stores and relationships with the manufacturers of those branded goods. They have a strategy of offering sales each week. They can't easily shift to everyday low pricing. In other words, it's really hard for them to modify everything they do to imitate Trader Joe's. They're stuck with the set of choices they've made to some extent. Moreover, there's the issue of mindset. The mindset of people operating a typical grocery store, well, that's very different than the mindset of Trader Joe's leadership. It's hard to change mindset as well. Well, you might say, maybe the way to imitate Trader Joe's is by setting up a separate subsidiary within one of these large grocery chains and let them begin to build a chain of smaller format stores to compete directly with Trader Joe's. Well, the large and successful British retailer Tesco tried just that. They created a chain called Fresh and Easy, launched it in the western portion of the United States to compete with Trader Joe's. Smaller format, limited selection of items, very much in the spirit of a Trader Joe's. But was it as good as Trader Joe's? No. Tesco, like British Airways and United Airlines, and like IBM in our previous lectures, they straddled. They created something neither as good as Trader Joe's, nor as effective as their main business at Tesco. So one of the reasons making trade-offs works really well is because you make it very hard to be imitated because of the commitments that companies have made that they cannot easily change. And you tend to increase the chance that your competitors will end up straddling in an attempt to compete more effectively with you. The Trader Joe's strategy of making trade-offs, though, is more than just about making it hard for others to imitate them. It's also helped them mitigate some of the very negative forces in terms of the industry structure. The unique array of private label products, unavailable at other retailers, diminishes both buyer power and competitive rivalry. When you're not selling the same goods that Stop & Shop and Kroger's and others sell, well, then people can't compare on price, and you don't get dragged into price wars. The distinctive in-store experience mitigates both buyer power and rivalry, and it helps to counter the threat of substitutions from other retail formats, including e-commerce. I asked one executive when I was running a workshop for a Fortune 500 company, I asked them about Trader Joe's. I was teaching a case study about the firm. And she said to me, I love the store. I go there every Saturday. It's my little Saturday morning vacation. Who would describe going shopping as a vacation? But at Trader Joe's, many customers do view it as an enjoyable experience. And by creating that experience, they've mitigated the threat of substitution from e-commerce to some extent. As for the everyday low pricing strategy, that minimizes price rivalry and buyer power as well. We're not in the business of having things on sale below cost to drag people in to then convince them to pay higher prices for certain items where we make our profit. They're not in that business. By having an everyday low price strategy, they minimize rivalry and buyer power. Mitigating negative forces is really key, and they do it in another way as well. Their willingness to alter their product mix frequently mitigates supplier power. Trader Joe's maintains a credible threat with regard to discontinuing products, as customers have come to understand that the product mix is highly dynamic. As a customer, I know that I may not see the same item I saw a month ago, and I've come to accept that as a customer of Trader Joe's. And the chain actually trains its employees to counsel me when I'm worried about the fact or I'm upset about the fact that my item is gone. And they're there to help you sample and try a new item that has replaced it. Suppliers don't have as much power if they know that Trader Joe's simply doesn't have to have their item because they're willing to change and move to someone else's item over time. Popular items will come and go, and many suppliers find it difficult to argue customers will be upset if a product disappears from the shelf or if a different manufacturer provides it. But moreover, the secrecy of the fact that many customers don't know who makes these private label items for Trader Joe's makes it such that Trader Joe's can offer the very same item under the Trader Joe's moniker, under that brand, change its supplier to get a better price in the negotiating table, and you, the customer, has no knowledge of that. Finally, locating stores in old strip malls offsets the power of real estate firms and landlords that charge high rents to many retailers. So you can see by choosing the strategy as they have done, they've dealt with an industry where the five forces, frankly, aren't very good. It's not an attractive industry. It's tough. It's a fight for profits. But their choices have mitigated each of those five forces in a way that's enabled them to be successful. So why don't other firms make trade-offs like this? Why is it so hard for firms to make trade-offs? We've listed a few that have done it well, like Planet Fitness, or eHarmony, or Edward Jones. Why don't others do it? I think it's because of the growth trap. CEOs want to grow the top line. They want to grow revenue. And trade-offs can constrain growth. They are the one downside, right? Because as you make trade-offs, you narrow the scope of the firm. You narrow your target market. And narrowing your target market means it's more difficult to grow that top line, to grow sales aggressively. Plus, it's very hard to say no to customers. Making trade-offs means when the customer comes in and wants 3 or 4 other items that you don't have, you have to be willing to say, no, we don't carry those items. We don't carry those brands. Sorry, we don't have a loyalty card. That's a tough conversation for many managers to have. They hear the request from the customer and they want to please them. But by pleasing them, they find themselves moving in many different directions at once, not making the trade-offs that enable them to be distinctive from their competition. They follow the herd and become more like their competition, where they're constantly saying yes to new customer requests. Why are some firms and some CEOs so obsessed with growth, you might ask? Well, for publicly traded firms, there's definitely the pressure to meet Wall Street expectations. But also, you have to note that large firms typically offer higher compensation to their executives. You get more publicity if you run a large firm than a smaller firm. If you're Trader Joe's, you're privately held, you're fairly secretive, you don't see the CEO's face on the cover of Businessweek or Fortune magazine. CEOs who become obsessed with growth often do so because it does lead to more publicity, a bigger empire that they get to lead, more compensation, and the like. There are some personal interests driving the obsession with growth for many companies. There's a real challenge, though, when you offer such aggressive growth targets as a CEO. You have to ask yourself, what does that mean when I say I want to grow at 15 or 20 or 25% a year? Let's think about that for a moment. Mathematicians have this rule of 72 that helps us think about growth of any number. So how long until a firm doubles in size? Well, if you take 72 and divide by the growth rate that firm aspires to achieve, you get the number of years it will take for that firm to double in size. So if a firm's trying to grow at 20% per year, it's going to take about 3.5 years for that firm to double in size. How is a firm that might have been around for 30, 40, 50 years going to double in size in such a short period of time? How are they going to achieve that aggressive target? Well, in many cases, what they begin to do is violate the key trade-offs that they originally made. So they began by having a long list of what they weren't going to do, things that made them distinct. But that created a very narrow target market. So how do you go beyond that? You begin to say, well, let's lop off a few of those trade-offs. Let's start doing a few things we didn't do in the past in pursuit of growth. Some have said that this is what Southwest Airlines has been doing recently, beginning to walk away from a few of those trade-offs because they saturated the market that they first set out to dominate in the United States. And so in looking for new growth, they've started to walk away from a few of those trade-offs. And maybe that's meant they're not quite as distinct as they used to be. The airline understands this, and they've pushed back on some of that criticism. It's been interesting to watch the dialogue between those who see them as violating some trade-offs and the managers there who see themselves as making smart choices to try to continue to grow. One other point about Trader Joe's that's interesting. Some point to them as an example of dual advantage. They're one of the rare cases, perhaps, where they've achieved differentiation and low cost simultaneously. Is that true? Well, I think the reference point here is crucial. If one compares Trader Joe's to a typical supermarket, you might say that they have slightly higher prices. Maybe they are premium and they have lower costs. But if you compare them to other organic or natural stores like Whole Foods, well, clearly their prices are lower, and therefore it's hard to argue that they're a differentiated player. Perhaps they are low cost, but not differentiated at the same time. Bottom line is, with Trader Joe's, it's hard to come to a definitive conclusion with regard to this issue of dual advantage because they're not a publicly traded company. We don't have their financial data. Moreover, because they offer private label goods, it's very hard to even assess the price level at the firm. Are their prices higher or lower than XYZ competitor? We're not quite sure because the products are not identical in both locations. This issue of dual advantage is interesting because many people come to a misguided view of the meaning of generic strategies. They confuse the term differentiation with the general notion of being different than the competition. It's important to note that low-cost players can be highly distinctive. Think Dell in its heyday or Southwest. But that doesn't mean they're differentiated in the precise way that Porter initially defined the term. In the original generic strategies framework, differentiation meant creating a larger wedge between willingness to pay and costs than the average rival by raising willingness to pay much higher than the average competitor while incurring somewhat higher costs. So many times people point to a firm and say they're both differentiated and low cost, but in fact they're not differentiated. They're not charging a premium price. They're just really different than other firms. And this makes it difficult when people misinterpret the framework. But whether you misinterpret it or not, the bottom line is Trader Joe's is a very interesting firm because at a minimum, it's a tremendous low-cost player with a unique store experience. And perhaps there's even a bit of differentiation there as well in some cases. Now this brings us to an alternative point of view on strategy articulated by Kim and Mawborn in a book, Blue Ocean Strategy. They wrote it in strict contrast to the work of Porter and his view of strategy. They argued that dual advantage is not only possible, it's much more prevalent in the world than Porter came to admit. That true innovators are able to break this trade-off between low cost and differentiation. They're able to create a new value proposition where they can, in fact, deliver both. And they point, for example, at one firm, one innovator, that they claim has done this very well. Cirque du Soleil. Cirque du Soleil, this hybrid between a circus and a Broadway show. This elaborate production, they charge a premium price, yet the authors argue they have lower costs than the typical circus. One point, they haven't really articulated the evidence behind that assertion on cost. On the issue of premium price, we all know that they do, in fact, charge a premium price relative to circuses. So Cirque du Soleil is their example of a company they would argue that didn't have to make a choice, that was able to achieve dual advantage. One weakness is some of their other examples I think don't measure up. Southwest, they offer an example of a blue ocean strategy company. But I would argue that's not dual advantage. There's no premium price there. There's a low-cost player that's different, that's distinct, but not differentiated in the sense that they have higher willingness to pay than many of their rivals. How do you create this blue ocean strategy firm, this firm that can break the paradigm in an industry and perhaps achieve dual advantage? They argue that what you have to do is think about what the typical firm in the industry is good at and not so good at, and flip that on its head. Can we be great at things that typical firms in the industry aren't doing very well? And can we sacrifice or cut down on things that other firms are investing a lot in? Maybe we won't do that. So at Cirque du Soleil, we'll invest in choreography and the composition of beautiful music, things that the typical circus doesn't do as much of. But we'll cut back. We won't have animals, and we won't have star performers. And by making those choices, we flip the industry on its head and create a very different kind of company, one that doesn't even have a direct competitor. How beautiful is that? Whether you're Trader Joe's or you're Cirque du Soleil, when you can't even identify a direct competitor very easily, well, now you know you have a great strategy. So Kim and Mauborgne, in their book Blue Ocean Strategy, ask 4 questions. They call it the 4 actions framework to help people think about how they might redefine an industry, how they might come up with a strategy that sets it apart from many competitors. They say, first ask yourself, what can we not do that others are doing? What can we eliminate that others are doing? What can we reduce that others are doing a lot of, we'll do less of? But also we can ask, what can we create and enhance? What are some things that others aren't doing at all that we could do? Or what are they doing a little bit of that we can do a lot more of? So what can we create and enhance? What can we reduce and eliminate? The 4 key questions, the 4 key actions to help us build a truly innovative strategy. Well, how different is that view actually than Porter? Many people who study strategy think of these 2 sets of authors as really in direct contrast to one another. But I would argue, in fact, these models have a lot in common. You should recognize rather quickly that trade-offs represent a common element to the work of Porter or the Blue Ocean Strategy authors. In their own way, each scholar emphasizes the importance of not doing some key things that many traditional players are doing. By eschewing certain activities that are commonplace in an industry, firms create a distinctive position that's hard to imitate. The Blue Ocean Strategy framework, in short, has much more in common with Porter's perspective than many people recognize initially. I like the framework from Blue Ocean Strategy because it does ask you good questions. It asks good questions that can help you sharpen your distinctiveness relative to other firms. And in the end, it's all about being distinctive. That's the key. So has Google, for example, have they reduced or eliminated things that other search portals did? They certainly did. They stripped down their homepage to something so simple. But they enhanced the search capability a great deal and offered something others did not. So in a way, their strategy fits the framework very nicely. So the framework can be helpful in helping us ask good questions to coming up with a better strategy. Now, one of the problems, I think, and why firms don't have distinctive strategies, why they end up so much like their competition, is they do a lot of benchmarking. And what happens when you benchmark? You typically look for the things you're doing much less effectively than the competition, and you try to catch up to them. Let's get as good as them on an item where we're lagging behind. Of course, that competitor, they're doing the very same thing. They're benchmarking you, they're looking at where they're behind and trying to catch up. But if you catch up to them on issue A, and they catch up to you on issue C, at the end of the day, the 2 of you have become much more alike. Benchmarking can lead to the homogenization of strategies. Benchmarking leads to less effective strategies in some cases. Not to say you shouldn't study the competition, but maybe you want to amplify what you do differently more so than you just always want to play catch up. Youngmi Moon is a marketing professor at Harvard Business School, and she has said that she has seen convergence in many industries, rivals becoming more and more alike. And she says in many cases, what she sees as she walks through the aisles of a grocery store or an apparel retailer, she says, I see heterogeneous homogeneity. In other words, on the face of it, I see diversity. But underneath it all, I see a lot of homogeneity. So in the bottled water market, she says, as I walk down the aisle, I see many different brands, many different flavors of water, many different pack sizes. And at the end of the day, it's all water. It's still a commodity. It's not truly differentiated. But all those things they've done to create many varieties of the same basic product, she says that's an expensive route to commoditization. It's truly convergence, not distinctiveness. So what are some of the lessons here for us? Strategy rests on unique activities. And to create a sustainable strategic position, you have to make trade-offs. Without making those trade-offs, your ideas can be imitated and you won't be able to sustain the advantage. So you have to be able to choose what not to do. That's really crucial. And that's tough. Because for many of us, we're not willing to make those tough choices at times. Not willing to say no to certain customers or no to certain activities. In part because we want to achieve that top-line growth. So your homework at the end of this lecture. Select a firm you think has been very successful in a particular industry and ask yourself, what trade-offs has the company made so as to distinguish itself from its rivals? Can you find a firm like Planet Fitness or Trader Joe's and analyze them? But then turn to a firm that you've seen try to pursue rapid growth, but maybe who's seen its distinctiveness erode recently. And ask yourself, what trade-offs has that company violated as it's pursued all that revenue growth?